Research. I'm here with, I'll start again. Hello, everybody. Welcome to our Macro Insights Livestream June 2025. Debt Market Tremors is the title. I'm Taimur Beg, Chief Economist at DBS Group Research. With me, Eugene Leow, Senior Rate Strategist. Chang, Liang, our FX and Credit Strategist. We have our summer intern Joshua with us, doing a little cameo as well. We have a lot to cover today, and although the title is Debt Market Tremors, we will cover a wider range of things. As you can tell, Eugene has been looking at the rate space. In fact, Eugene and Samuel Say published an article called The Case for Asian Bonds earlier this week. And also, Liang, in addition to looking at credit and FX, he also looks at crypto. So in case anybody has questions on these issues, feel free to send it through our question pipeline, which I will display in a second. But first, the outline of this presentation. I'll go first. Although it's written here, I'll cover the US. I'll actually cover the US and a little bit of EM Asia. Eugene will talk about rates. And again, in this rate space, we will discuss both the US developments as well as in Asia developments. Something on Europe too, perhaps? Yeah. And then on the currency side, Liang will weigh in. I don't think he'll have time to go over crypto, but we're happy to take those things during the Q&A. So how do we do the Q&A? We will go to pigeonhole.at, and you will enter the passcode macrojune25, or you can just scan the QR code that's on the screen right now, and you can send in questions. Don't worry if you are not being able to copy the HTML link right now, or if you mistype it, because we will bring this up between every single subsection and flash it over and over again. All right, let's get going. William, next slide, please. US. Is this the calm before the storm, or are we left the storm behind us? Did we panic too much about this Trump tariffs? Is this the case that Trump will always chicken out, and as a result, the market is now basically calling his bluff and behaving as if the trade war will not be as intense as feared in April? Well, let's think about that in the context of a few things. First, the macro context. The dynamic for the first quarter of 2025, as for the US economy, was anomalous to say the least. In anticipation of tariffs, there was a lot of advanced imports being done by US companies. And as a result, the X minus M part, the M part, import part, went through the roof, and net exports contribution to the US economy became very, very negative. And as a result, from early February onward, as soon as Trump started talking very hawkishly about the trade war, Atlanta Fed's nowcasting started showing sharply contracting GDP. It wasn't a very big source of concern because it was clear that whatever was being advanced for the first quarter would be showing up as less import in the second quarter, and there'll be a payback and there'll be a big upside. And that's exactly the way it is manifesting right now. We had a slightly contractionary first quarter when the GDP national accounts came out. That's all behind us. For the second quarter, the Atlanta Fed is tracking something in the range of 3 to 4% GDP. There was a moment it was even tracking higher. We think that when the dust settles, all this distortion ebb away and the balance each other out from the first quarter and second quarter, taken together, you still would show something in the range of 1.5 to 2% growth rate. So right now, the data would be very noisy, and we will show you a series of data which reflect the fact that there's a lot of noise going on there. So that's the real economy part of the US. There is some evidence of hiring is slowing on the margin, not in a very worrisome manner, but it's slowing. Certainly, as far as the government hiring is concerned, that's fallen off a cliff because of DOGE and other activities. But U.S. public sector is not the key producer of jobs in the U.S. economy. Private sector job creation is still relatively robust. The production side, some degree of pessimism among producers, particularly with respect to price, but also with respect to demand. But again, nothing hugely worrisome. On the margin, some sign of demand weakness, and on the margin, some fear of inflation going up. Speaking of inflation, the second panel of the chart, as you can see, ISM manufacturing surveys certainly suggesting some degree of concern about input price going up. This chart is very helpful in terms of leading indication of what's happening to core inflation in the US. If you see the chart going back to 2020, ISM manufacturing started reporting significant pickup in price pressure, which only manifested in higher core PC, a good 6-month lag. And then again, it began to ease more or less concurrently with core PCE came in. So the bottom line from this chart is that ISM manufacturing would anticipate pickup in inflation, whereas when it comes to inflation ebbing, it'll be a bit late in picking it up. But right now, we're only worried about the up part, which is it going to anticipate higher inflation? The answer is yes. So the red line is showing core PCE right now is benign. This is going to get dragged up by the ISM manufacturing price survey numbers. We're relatively confident about that, and which is why we do think that the low 2 core PCE will make way for high 2s, perhaps even 3% core PCE by the time the year ends. Moving on, there's been very sharp shift in confidence. So far we've sort of looked at concurrent and backward-looking indicators. Let's look at some forward-looking indicators. So here, University of Michigan survey, that shows extremely high expectation of inflation, and that's something that we didn't even see that magnitude in 21, 22. And consumer sentiment has also sort of nosedived. We really haven't seen such weakness in consumer confidence in a very long time either. Now, will these things manifest into weak sales? Would they manifest in consumers asking for wage increases at their workplace when they go back because they are expecting consumer goods to go up in prices, and in anticipation of that, they'll be expecting their employers to give them higher wages? We'll see whether that happens or not, but clearly the big takeaway from this is that the April 2 reciprocal tariff announcement really had a seismic impact on consumer confidence and expectations. You should not always be able to take these things as a marker for actual data to come, because there is an endogenous policy response as well. Policymakers are not in a vacuum. They also see what you and I are seeing, and they will then try to ease trade war or try to moral suade companies not to raise prices. We've seen that with respect to Amazon earlier, that Trump was very critical of Amazon trying to tell their consumers or customers that how much of the price was tariff related and how much it was not. But the fact of the matter is, even if there is some degree of endogenous policy response and there's some degree of detente with respect to trade war, as we're seeing now, some of the damage is done. And maybe it will not necessarily show up in consumer spending. We know for a fact it is showing up in investment spending. The uncertainty, first and foremost, has already manifested in some degree of paralysis as far as investor behavior is concerned. When they see these sort of shifts in consumer sentiment, it immediately leads to them saying, I really don't know what to do. Do I do China plus one? Do I completely give up on China? Do I only focus on the US? Or do I ignore the US and focus on the rest of the world? All of those things are causing investors, by and large, to basically not do anything and try to see where the dust settles. Unfortunately, we don't think the dust is settling anytime soon. Every few weeks, there'll be some drama around these things, and that's bad for investment sentiment. So when we look at 2025 growth outlook around the world, one of the things that we're sure about is the fact that investments' contribution to growth will be lower. We're not 100% sure how weak consumers are going to be, even if their sentiment is poor, but we're quite sure investments' contribution to growth will weaken. Next slide. Now, this is an area where both Eugene and Liang will weigh in later on, but I just want to point out a couple of things that what we're seeing right now is anomalous, to say the least. We have had the U.S. yield curve sort of shifting down in the initial months of 2025, now sort of shifted up again, as you can see at the long end of the spectrum at 10-year end, which is the end of this yield curve that I'm showing in the left panel. We're more or less where we were at the end of 2024. In fact, if I had extended this chart and showed it all the way to 30-year Treasury, 30-year Treasury yield, Eugene, if I'm not mistaken, is higher than where it was at the end of 2024. So the U.S. yield curve itself is showing the belly part being lower than N24, and the end part showing actually higher than N24. In the meantime, Singapore's yield curve has also shifted down in a very, very dramatic manner. I think the kind of spread we're seeing at the 2-3 year end mark, as you can see, in the case of Singapore, it's like down to 1.6%, where in the US, it's still in the high threes, if not 4%. That sort of stuff, that kind of spread is rather unprecedented. Again, I'll let Eugene weigh in on this later. But my point is that on one hand, we have this uncertainty around growth, uncertainty around investment. On the other hand, on the financial side, we're seeing rather anomalous developments in the fixed income curve. I'll touch upon the US side a little more later on. Let's also talk about the exchange rate stuff, Liang's territory, but I just want to point out that on a net position perspective, the market has gone pretty short US dollar in a pretty dramatic period of time. Just look at it, late 2024, the market was overwhelmingly long US dollar. And since then, it has become overwhelmingly short US dollar. And the DXY is, of course, below 100 now. And in good old Singapore, we're looking at 128 against the US dollar. So lots going on. I want to come back to this if I have time during the Q&A section, particularly with respect to, on a 5-year basis where these exchange rates are. And the appreciation that we've seen in some currencies against the US dollar, is it seismic, substantial, or is it still pretty on par for the course? In fact, Liang, you should sort of weigh in when your turn comes to address these issues. Next slide. Okay, so we published a piece on Asian trade yesterday. So we have all of April data for trade, and we have all of May data for PMI. And for a few countries in Asia, we also have May trade data. But this slide is only about April, comparing April PMI with April trade numbers. And as you can see here, real divergence. Manufacturers have gone all very bearish about the outlook. But as far as their actual exports are concerned, things are really, really hot. I think this is the flip side of what we were discussing earlier in the context of the US. In the first quarter, American importers decided to advance a lot of their imports, and as a result, the order books of Asian companies filled up. And when we think about ASEAN 6 countries, we haven't seen this strong year-on-year exports growth in a very long time. And even beyond ASEAN, take all of Asia, including Korea, which is not doing that great, but still, you have high single-digit growth in exports. I said just a second ago that we also have data for May for a few countries. So let's look at that. Next slide. China and Vietnam. We have May for both of them. Now look at this. In the case of China, exports are up. Although if you read the headlines yesterday when China's exports came up, you probably read something like exports are down 15%, but that was in the context of the US. So China has exports to the US contracting sharply. China has exports to the whole world rising pretty robustly. This has a wide range of interpretations. I mean, where are all these exports going? Are they just going to Vietnam, Mexico, just the way they did in the past? The China plus one story, they'll just go to the US after that? Or is China really taking all those goods they cannot sell to the US anymore and selling it elsewhere? I think the second issue is a legitimate dynamic for the future. I think in the near term, it is really the former, which is still transshipment to the Vietnams, Mexicos of the world, which will then end up in the US, tariff, reciprocal tariff, pause, non-pause, all that thing notwithstanding. Even think about Vietnam. Sentiment in Vietnam is very poor. PMI has contracted sharply in the last few months, and legitimately so. 46% reciprocal tariff is hanging over Vietnam. The Vietnamese authorities were very proactive. As soon as these things were announced, ran to the US, didn't really get anything in return. And we've seen recent congressional hearings where US politicians have expressed zero interest in giving Vietnam any relief because they feel Vietnam is very, very China adjacent. That's all true, but it is also true that Vietnam's total exports are up 16% on a year-on-year basis. I'll show a little later what is happening to Vietnam's exports to the US, also going very, very well. So we have a great deal of distortion in GDP data. We also have a great deal of distortion in the trade data. There's a big divergence between sentiment and actual trade. Next slide. And as promised, we will look at exports to the US. Again, look at the divergence within the region. China, free fall in exports to the US. By the way, I've smoothed this out. It's a 3-month moving average basis. Actual number for the month of May is even worse than that for China. And then Korea, basically seeing a bit of a soft patch as well. So their exports to the US is also in a contraction territory. But then look at the rest. Vietnam is up like 40%. And again, the actual month of May numbers are stronger than this. I have it on 3-month moving average basis. Taiwan, 50% on a year-on-year basis. Again, 3-month moving average. I believe the actual number for Taiwan for the month of May is like 87% on a year-on-year basis. Even India is looking at a purple patch, substantial growth, and Malaysia also extremely strong. So this is not going to last. I'm pretty sure about that. If we come back to you 3 months from now or 6 months from now, we will see an inverted V as far as exports are concerned from these countries which are having their moment in the sun. Things will weaken. for the time being, let's just take the good numbers. It probably also tells you that we don't need to be too worried about overall demand in the US. We're already in June. Half of the year is over. I don't think, even if the US slows in the margin, consumption is going to tank, because these numbers suggest that the shelves in the US grocery stores, or other department stores, will be very, very full going into back to school in September, or even Christmas in December. Move on. So, reciprocal tariff. We are talking to you on the 11th of June. We came to work this morning with some headlines about a handshake on the framework for the trade agreement between US and China. Don't really know what that means, but let's prognosticate a little bit. We have less than a month to go before the reciprocal tariff pause is over. We will probably see a few deals here and there, Canada, Mexico, maybe even India. And that would generate some headlines. But again, these are deals. Let me be very clear. I mentioned this in the last live stream also. There's a big difference between a deal and an agreement. Deal is very high level, political, president of a country with the prime minister of another country, bunch of MOU, 5 pages, 10 pages long. This is not a trade agreement. Trade agreements are ratified legal documents, thousands of pages sometimes, extremely detailed product by product discussion. We have none of that happening. The US may be a big country. It may be all in with respect to trade war. They do not have the bandwidth to do 150 trade agreements around the world. It's just not going to happen. So we will see some high-level discussions about buying more from the US, buying less from China, investing more to the US, or maybe even some non-trade related issues like appreciating a country's currency, or rather not intervening at least, that sort of stuff. But I personally don't think we're going to see any very substantive deals, even with respect to India, which may be at the top of the queue in getting something done with the US. Don't expect all countries to get some deals and reliefs. And with that, I really have Vietnam in mind right now. The Vietnamese authorities have allowed Trump to open properties in Vietnam at a fast-track basis. They have offered to drop all tariffs, like 040 vis-a-vis the US. And some US congressmen are actually very impressed with some of the things the Vietnamese want to do. But US congressmen being impressed by Vietnam and White House being impressed by Vietnam are two different things. US government, as it stands right now, has zero desire to give Vietnam any relief. They see Vietnam as the same as Cambodia and Laos. They're not, and they're wrong in them thinking like that, but that's the way they believe. And then there certainly would be some extension of pauses, particularly with respect to China and EU, all sorts of handshakes notwithstanding. Nothing really will get done on a full range of products. And I really don't think Trump will ease up on steel and aluminum. He won't. That's very close to his heart. Even autos, I really don't think he will. On rare earth, clearly that is one area China has a lot of leverage, and the US will have to play ball, because we're even hearing from US automakers that they might have to move some of their part manufacturing all the way to China if China doesn't allow magnets to be exported. Things we learn. I didn't realize magnets were such an important part of the global supply chain, but it clearly is. It's really been one area where China seems to have a lot of leverage. Similarly with European Union, I don't think the US will be able to get the EU to just agree on some high-level stuff. EU simply does not work like that. There's a huge bureaucratic apparatus around the way EU deals with trade. US will not be able to just announce some big deal out of that. I don't think anybody is going to be exempt from 10% baseline tariff. Countries like Australia, Singapore, very closely aligned with the US on multiple dimensions. Singapore, in fact, runs a trade deficit vis-a-vis the US. Even then, the US is not going to give Singapore a buy. So that's my view. Let's go to the next slide. So debt market tremors. Again, there are things that Eugene will talk about. I just want to point out about the fact that real yields are substantially high now, and this should be very bearish for the equity market. This should be very bearish for gold. Neither is the case. Equity markets have recovered their lost value. Gold is at record territory, 3,300 or 3,100 or so. This is very anomalous. This is not what you should expect. Meanwhile, bond market volatility remains elevated. It picked up a bit in April, so much so that it sort of worried Trump and Besant and others, and the theory is that made them call for a big pause on the trade war, but that doesn't mean that there's been significant easing of bond market volatility. There's serious worries in the markets about how much appetite there is among investors to absorb the billions and billions of issuance that's coming out of U.S. Treasury on a weekly basis. Next slide. And there are good reasons for that. This year has been characterized by the US government getting all sorts of headlines of firing government workers and canceling expenditure plans with respect to USAID and health and sciences and canceling grants on universities, et cetera, right? The black line is the latest data. Actually, it extends into June, although the chart might suggest that it's through May. It's got a few days of June data as well. And what this data tells you is that so far this year, the US government has spent 7% more than it did last year, cumulatively. In fact, last year at this time, during Biden's time, US federal spending on a cumulative basis was slightly below than where it was in 2023. So 24-23 at this time last year was negative growth. 25 over 24 at this time this year is up 7%. So there's significant amount of spending rigidity in the US, notwithstanding all their attempts to cut spending willy-nilly. Defense, interest payment, Social Security, all of those things. There is a big bill, or rather the big, beautiful bill that Trump wants to pass. It's passed the House, gone to the Senate, has to pass the Senate and go back to the House because the Senate will make some changes to it. Look, if it's all about tax cuts, in the long term, it'll probably add a bit to the growth. I'm showing you a slide from Tax Foundation, and their big computational general equilibrium model shows that it could boost US growth in the long term, but it will also add substantially to US debt. It's 2.6 trillion under just static assumptions. Even if you believe that growth will pick up and that will offset some of it, it still would be a multi-trillion-dollar increase in US debt. Final slide on my section. Oh, that's it. So just go back for a second, Liang, because our next section is with Eugene. I just want to point out that US debt-related worries will be a feature of global markets going forward. As Eugene and William will both show you that some of the anomalies that I just talked about, the real rates being high and therefore equities should be affected, but they're not, real rates being high and gold should be falling, but it's not, again, shows you that there's a lot of non-normal things going on in the market, and we have to sort of keep focus on that to make sure that some of the complacency pervading through equity markets is not the only thing that we look at. There are other things to worry about. Okay, I'm going to stop there. Eugene.
Okay, thank you very much, Timer. So for me, it's really taking a few steps back, right? So a lot of things on tariffs, the rejigging of supply chains, rare earths, those are the battle fragmentation across the goods side. And then we will likely see more fragmentation on the services side. And for my section, I'll be talking more about the fragmentation on the monetary system, and in which case, how do we allocate monies and how should we invest? Right, so next slide, please. So when we think about investing, right, I think if we go back to the basics, we should be looking at some of the core principles. So the first thing would be store of value. When we put money into an investment, we should reasonably be able to get the same value back, right? So if you look at it from a country level, we should have confidence in the country's fiscal, economic, and political conditions. And very importantly, the clarity in terms of the rules. Now, another point that would be important would be liquidity. So if you are the large investors and you have to deploy hundreds of billions or trillions of US dollars, there are not that many markets that will allow you to do so easily. Right? And then the other point when we're investing is that we hope to generate above trend returns. Right? For each local currency, the safest would be, say, short-term interest rates that are linked to the government. But if you're going to take on duration risk, credit risk, or equity risk, you should be compensated appropriately. And the sense is that for most investors, when we think about our portfolios, it is still very heavily tilted towards dollar assets. And the chart on the left shows you how it is for the reserve managers, which is a very large chunk of the market. And if you look at that, in the dollar space, dollars make up close to 50% of total allocations. And that is more than pulling the weight, considering that the US economy makes up only 1/4 of the world's economy. Right, so the second largest allocation would be euros, and that would be 17%, and then gold 15%. The rest are very small. So for example, if you look at Chinese yuan allocation, it's about 2%. But the size of the Chinese economy is about 17-18%, right? So much, much larger. So if you go against looking into this kind of backdrop, then some reallocations have to take place. So next slide, please. Yeah, so, and we know that investors are looking at this more seriously now, especially since post-Liberation Day. So just to get a sense of how 10-year local currency govies have moved. This is 10-year yields. They're spread across G10, some EMs, and Asia. So there's some things that stand out. Right? Generally, yields are lower. Right? But for the US, yields are clearly higher. So we can look at it in terms of both economic conditions as well as the need for diversification. Right? So if you look at it from an economic point of view, if the US is imposing tariffs, it would mean that growth would be facing some friction, not just in the US, but across the rest of the world. So there will be downward pressures on interest rates. But for the US, things would be a bit conflicted because aside from facing potentially slower growth, they might be facing higher prices. So there's a bit of a stagflation-like play over there. So in which case, from an economics point of view, the hit onto rates are mixed. Now, from a diversification point of view, we can also think about it that way. If people do not want to hold that much dollar assets and they want to diversify somewhere else, then it makes sense, right? Yields in the US could be higher and yields elsewhere should be lower. Right, so we should be viewing this from two angles. Right, next slide, please. Yeah, we can also drill deeper into the breakdown. So over here, the three different charts show you the breakdown of the 10-year yield movements across the US, Germany, as well as Japan. And we've broken down the movements into where the policy rates are, the expected changes in the policy rates, inflation expectations, and then the term premium, which is the residual that captures everything else. So if you notice, right, there is a spike in the gray area over the last few months across all three, and that is the term premium component. But the drivers of all three are slightly different. For the US, we think it is more of an erosion of confidence. So if you are no longer thinking that the US is that exceptional, then perhaps the price premium shouldn't be so high, and therefore the yield premium should be a little bit higher. Especially when we come into think about the context that fiscal could be an issue that the US will be facing for quite a while. Now compare that with bonds. Similarly, you have term premium rising, but I would argue that this is more of a benign case where it captures increased optimism of the growth outlook, right? Insofar as the Eurozone, as well as Germany, has been underspending for the past 15 years, and there are signs that could change, then this is really a more benign adjustment, whereas infrastructure spending kicks in, as military spending kicks in, and we get a better mix right across the curve. For Japan, I think a lot of attention is paid on the very ultra long ends, 30, 40 years. But we have the same issue of term premium creeping in. Part of the reason is because the BOJ is keeping rates lower than where it should be in the front end. And some of the concerns are spreading out to the longer tenors, a little bit onto the long end like 10, but a lot into the ultras. Next slide, please. Yeah, so we've talked through a few lenses of viewing government bonds, but there's another very big player, and that would be the central banks. And whether they're doing QE or QT is very important. And over the past 2-3 years or so, we've been largely running quantitative tightening, meaning that generally the central bank's balance sheets are shrinking. But this makes sense because the economy generally has been holding up well. But if the bond market starts to get messy, then you would expect the central banks to come in. So if we see long end yields spiking beyond certain pain thresholds, it is very likely that taper could stop, quantitative tightening could stop. They might have to buy some long end bonds. So these kind of tweaks will come in as central banks come and safeguard financial stability. Next slide, please. Now I'm just going to zoom into a few of the more interesting cases right in the DM space. So first off is JGBs. So Japan is an interesting case where inflation has been persistently high. I think within the G10 space, it is one of the highest. And you contrast that with the policy rates of just 0.5. So which implies a real rate that is deeply negative. Right, so by purely economic measures, the BOJ should be hiking a lot more. But yes, so concerns is to balance other kinds of risks, right? So it's not so easy to hike that aggressively. But insofar as the market thinks that the BOJ will be more concerned on everything out to the 10-year tenor, then the pain expresses itself in the 30-year and the 40-year, where you see that yields actually poked above 3%, which is very, very high with Japan standards. But I would argue that for the ultras, the hit to the real economy may not be that big, right? So there would be a need to manage it from an optics perspective, meaning that uh, the MOF might want to issue less of the ultras and more towards the front and belly. Then perhaps the slowing down of the QE pace might eventually have to stop. Right, so there will be some rejigging going on, especially as we think that the POG probably still has some room to normalize, but there probably won't be a lot of tolerance for further blow-ups in the ultra-long ends. If the 10-year goes above 2%, we suspect that another paid threshold would be crossed. Next slide, please. Now, another interesting case would be Switzerland, right? And that is where we see another instance where negative rates have come back again. And that's just the very front end, right? So 2-year yields, if you look at some of the OIS at the front, yes, they've gone negative. So when we look at the Swiss economy, right, there are many factors that are aligning to drive front end rates lower. So if you look at, again, economics first, the unemployment rate has been rising for quite a few quarters. Right, so economic is weakening. And if you look at CPI, it has dropped below 0. So from a pure economics perspective, they should be keeping rates low. And if you look at the rate cuts they've delivered over the past 1 year or so, they have been fairly aggressive. Right? So then the other angle that we should consider is there's rebalancing going on. Right? So they have a large NIIP position, meaning as large as a base, it's about $1 trillion US dollars. So intuitively, it also means that there's a lot of appreciatory pressure. And if you think about rebalancing flows as well, a lot of inflows. So again, this brings interest rates under tremendous downward pressure. And this is a unique case. It's not so easy to resolve. But I would say that some curve steepening and negative rate speculation is probably inevitable. Next slide, please. And so moving away from DM, we're just going to talk briefly on Asia. And I think the key we have to answer, right, is that do we have to rethink the Asia risk premium? So, and it's always relative to G10. Right? So I just take the average of the G10 govies, local currency use, and do something similar for Asia 7. So you compare the red line and the green line. For the most part of the past 20 years, Asia always has a premium. And intuitively, it makes sense because Asia is perceived to be more risky, and then the G10 is perceived to be safer. And during periods where the G10 have to keep interest rates very low, the premium widens out. Right? So, but this is mostly a DM kind of issue. But if you notice over the past 5 years, while the DM space hiked rates a lot and drove interest rates much higher, the reaction in Asia is much more muted. And if you zoom in again to the past 2 years or so, DM rates have arguably been rising, but for Asia, they have been falling. Now, these are all on the aggregate level, but it's interesting that this Asia yield premium has largely disappeared, and it has in fact gone into a discount. Now, there will be idiosyncratic things to think about, but we think that structurally, if there's rebalancing flows, if people are rethinking EMDM risk, then this could be a very narrow spread that we will be facing for a very long time. Next slide, please. So when we look across Asia, it is heterogeneous. So depending on what investors want, or if you want safety, then you have SGS, rare AAA asset. And then if you want low volatility with chance of rate cuts, SMGS. And then if you want a bit more return, right? And then if you want to reach for a bit more duration for return into GBs, IGBs. And if you want something as an alternative to USDs, you need some of the size, and that would be CGBs. So again, different risk appetites and different requirements spread out across different instruments across Asia. Next slide, please. So if you look, again, zooming in on some of the more interesting cases, just talk about Singapore and Hong Kong. So remember I talked about how there's been this divergence, right, between Sing and US interest rates. We are seeing it. So if I just compare 10-year US and 10-year Sing, and you notice that directionally they seem to be going different, US up and then Sing down. They are correlated, but we have seen the spreads tear. And these spreads we have not seen for the past 15 plus years, right? The last time spreads were this wide was during the pre-GFC era. And back then, we have the case where US rates are very high, similar to where we are now. And also, there was tremendous optimism on EM in Asia back in 2006 to 2007. So I would argue that something similar is coming now, but also there's also the rebalancing flows that is kicking in as people start to have some erosion of confidence on the US side. So for Hong Kong, I compare using the 5-year EFN and USD use. So similarly, we start to see this divergence that is taking place, right? So when we look at the Hong Kong dollar, the peg, and we can see whether it's on the strong side or on the weak side. And recently, I think it has been skewing a bit more towards the strong side, so more liquidity, more inflows, and because it is a peg, more liquidity is being generated, and that is bringing down Hong Kong interest rates as well. So you notice that there are quite a few economies that's facing this kind of consideration. So Swiss is one, Singapore is another, Hong Kong is another. Right? So these are not unique, it's representing some rebalancing going on. Next slide, please. So will the rebalancing take place for many more quarters, many more years? I think the answer then comes with how allocated investors are to Asia. And I think the answer is probably not, because since 2022, if you look at the interest into Asia, which is represented by this chart, it is really intermittent. Right? So because the US was exceptional during the period, you have US interest rates being very high, the US dollar being very strong, there's almost no point in allocating your monies anywhere else. But that has changed, right? That has changed, and perhaps you could see a sustained period of rebalancing. So in which case, where we are now, even though there's been some build-up of interest, I think that Asia is still pretty underowned compared to where we were in the end of 2019. Right, next slide, please. So wrapping up everything into takeaways, I think there's a lot of fragmentation that's going on, a lot of focus on trade flows, spilling over a bit into services. But in terms of financial markets, we are looking at where to put our monies. That too is likely to require a rethink. And as investors reallocate, we are already seeing some of the moves appear in the interest rate space. Right? And then as we think about this issue structurally, we think there's a strong case to be made for Asian govies. And by our estimates, it is still, Asian government bonds are still very, very underowned. And this trend could persist for quite a few more quarters.
Very good, Eugene. Excellent. A couple of questions, but let's give Liang a chance, and I'll come back and ask you the questions. Liang, just flag the previous slide. Yes, so to those who have any lingering questions on Eugene's sections or my section, or about to have something from Liang, dbs.pigeonhole.at, enter the passcode macrojune25, or scan the QR code that's on the screen, and I will take your questions as soon as Liang is done with this section. Liang, all yours.
Right, thank you. So I think for my section, I'll have a brief review of what happened after the Liberation Day tariffs, right? So Trump views Liberation Day as him liberating America from unfair trade practices. But the truth is, it is also liberation in the sense of global investors liberating themselves from very erratic US trade policies. We see very significant outflows away from the US dollar because don't forget that the US economy has prospered over the last 40, 50 years from having more trade, not less trade, from having different trade ties, different investment flows across different countries, and having the rules-based international trading norms. Seeing such upheaval in this space is actually quite negative for the US long-term growth prospects. So I think investors are recognizing that the returns to capital by investing in US is probably not going to be as great as what we have seen in previous decades. So they're taking a chance to take profit from very highly valued US dollars. They're returning and repatriating assets back into the local currency. So if you look at the performance of currencies since Liberation Day, you will be a little bit surprised to see actually it's the exporters economies such as Korean won, Taiwan dollars seeing the largest gains. And why is that? Because they are exporter economies, they are the ones who are most invested in US dollar assets, and we're seeing genuine repatriation pressures, flows coming back onshore. And that's also permeating across into other major currencies. They're diversifying. Global investors are diversifying out US dollar assets. They are reinvesting back in Europe, back in safe havens, including Swiss franc and yen as well. For the RMB, not so much of a gain, primarily because the PBOC is still on an easing stance, but we still see a little bit of a gain coming through since Liberation Day. And this diversification flows away from the US dollar. It's not just a currency story, right? So if you look at the other alternative store of values, such as gold, Bitcoin, they all done pretty well since Liberation Day. So gold is up close to 10%. Bitcoin, very strong performance, 30% rally since then. Part of it is due to the exuberant risk appetite we see in equity markets, because Bitcoin is a very risk-sensitive asset, but also to some extent, people are believing the value is better held outside the dollar in such alternative assets. On the other hand, commodities that are more linked to economics, demand conditions such as oil, not really seeing a very significant rally. And speaking of inflows, we also seen very large inflow waves going to managed currencies, such as the Hong Kong dollar, such as the Singapore dollar. So very interestingly, because the dollar Hong Kong rate is set by HKMA to between 7.75 to 7.85, all these inflows going into Hong Kong dollars. What it means is that HKMA, in order to maintain and defend the peg, they have to be essentially buying out US dollars and selling Hong Kong dollars. So there's been an expansion in Hong Kong dollar liquidity because of these actions. This expansion of liquidity has very significant rates consequences. It really resulted in a very sharp drop in HIBOR rates. So what that means is also that you see very anomalous behavior in the dollar Hong Kong 12-month points. So because the peg is between 775 and 785, that's only 1,000 pips. Under normal circumstances, the dollar HKD 12-month points should not exceed 1,000 to minus 1,000. But right now, it's more negative than minus 1,000, indicates the very low HIBOR rates on a 12-month basis against equivalent US dollar rates. So taking advantage of this carry opportunity, this potential arbitrage opportunity, as long as the peg continues to hold, we see dollar Hong Kong now coming back up towards the higher end of the band. That probably will allow HKMA to absorb some degree of Hong Kong dollar liquidity. It's a very similar story for the Sing dollar, because the Sing dollar is managed against the senior MS senior band, and we've seen since Liberation Day, yes, there was initially a little bit of a dip in the senior, but now it's trading back up towards the top end of the band. So what it means is that actually MS is also stepping out in terms of the necessary liquidity injections in the market to keep senior within the trading band. So it's pretty impressive that this is happening, even though MS has actually reduced the slope twice this year, back in January and also in April. So just a very short chart showing how anomalous the rate situation is in Hong Kong. We see the HIBOR 3 months plummeting from over 4% to now just around 1-2%, showing a very large discount against equivalent 3 months over rates. Similar story in Sing, but not to the same extreme. We've seen actually SORA rates, 3 months rates coming down quite significantly, even though the SOFR rates are still unchanged, because the Fed essentially is still on hold. So the liquidity conditions is actually having some positive impact on asset markets. So just last week, I was on CNBC and Anchor was saying, look at the falling Hong Kong HIBOR rates. They'll probably be good for a mortgage, and it's true. We think that's likely to be to some extent, help to bolster home buying sentiment, perhaps in real estate sector in Hong Kong. So speaking of possible destination of all these inflows, one beneficiary could be the Swiss franc, given that it's a safe haven. It's considered to be a very stable store of value. But the problem is, all these inflows is not necessarily welcomed by Swiss National Bank. Why? Because if you look at the CHF valuations, they are pretty much close to the extreme. So based on the DIA valuation metric, the Swiss franc valuation is close to 12% overvalued right now. It's very close to when, back in 2011, when SMB introduced a price floor on Euro Swiss in order to prevent further appreciation on the front. And we have also seen that in the SMB monetary operations, liquidity operations, they essentially stop all FX purchases that they were doing back in 2023, 2024, in order to actually strengthen the Swiss franc to lower inflation. Now inflation is going the other way. It's actually dipping below zero. So actually, instead of being concerned about inflation, the SMB is now somewhat concerned that inflation might undershoot the target. But does that mean that they're going to intervene? So that's where Trump comes in. So the US Treasury published a report highlighting countries that are worth monitoring, particularly countries with a current account surplus, and B, having a large trade surplus with the US. And Switzerland ticks the checkbox on both metrics. So if SMB is to intervene, is to weaken Swiss franc, that's likely to mean they're going to be caught out for manipulating currency by the US Treasury. So right now, the only alternative perhaps is for SMB to really look at rate cuts or even to go into negative rates. So they were previously at negative rates back in 2012 to 2014 period. So it's not unheard of, but of course, that's likely to hurt, I think, profit margin of Swiss banks. In terms of another possible beneficiary, that would be the yen, because the Japanese are such a large holders of US dollar denominated assets, right? So if there is some degree of concern over the economic policy of the US, if there's some concern that they could be penalized to some extent by holding US capital or US assets, then there could be some degree of a repatriation. And also on the domestic front, things look pretty good. If you look at the JGB 30-year U, the so-called ultra-long segment of the Japanese bond market, actually they are at highs that we've not seen since essentially the early 2000s, right? They are around 3%. If you look at where they are compared to the US Treasury 30-year U, that gap has narrowed. So there's possibly some degree of inflows that will come, or repatriation flows coming back from US Treasuries into JGBs because of the narrowing gap. Also at the same time, the US Treasury 30-year U is rising not necessarily because growth is upbeat, but also because of concerns over the US debt burden. So there's a difference. So this rise in 30-year U is not as positive as the rise in the JGB U's, where you could see some degree of reversion back to more normal term premiums. That's really driving the real rates higher. Meanwhile, is the BOJ continuing its rate hike policy? The answer is likely at a slower pace, but still with inflation being somewhat persistent, even though underlying inflation in the BOJ's view is not quite as strong, it's not quite near its 2% target, but there's definitely a positive chance for them to be looking at further normalization, further rate hikes, given the fact that inflation so far has been fairly strong. So if you look at the USD JPY 2-year rate differentials, that has also come off quite a bit from the highs back in 2023. And historically that has correlated with the dollar yen quite well. So dollar yen, maybe we could see it heading back closer towards 140 level if this trend continues to persist. So there are two factors, rate differentials as well as some degree of uncertainty over US policy risk. So I'll just wrap up my section looking at the deal valuations. So part of the driver for the outflows away from US dollar is also because the US dollar is quite overvalued. So based on the deal, we think it is around 18% overvalued compared to its longer term fundamentals. So definitely a lot of downside if the economic policy environment turns a lot more uncertain, a lot more negative for US growth. That's likely to drive capital out of the US. Whether or not there's going to be a tsunami or a trickle, I think it very much depends on what the Trump administration does at this point. So right now, they are putting more emphasis on negotiating trade deals. That's still keeping market sentiment somewhat in check. But if they revert back to very high tariffs, very protectionistic stance, then that's probably a lot more negative for the US dollar. So in terms of the difference between yen and Swiss franc, I think the yen probably has more room for appreciation than Swiss franc, primarily because Swiss franc is so overvalued. So there's a chance that the BOJ could be hiking rates, but the SMB is looking to bring rates into negative territory. So that's going to be somewhat helpful for the yen against the Swiss franc. In terms of what's going on in managed currencies, Sing dollar, Hong Kong dollar, domestic liquidity is still likely to be flush because all this inflows is going to take time for it to normalize. So probably we could see rates being a bit lower than usual compared to US dollar rates. So with that, I will pass back to Timer.
Thanks very much, William. Eugene, two questions. Question number one, we just saw from William that interest on JGBs have soared a lot. We talk a lot about fiscal sustainability in the US, that who's going to absorb so much debt at 4%, 5% interest rate? Who's going to absorb all these JGBs?
The BOJ is still sitting on 50% of all the JGBs, even after they're slowing down the pace. They're actually still running QE.
And
It's just at a
them
slower
running
pace.
capital loss is not a big deal because they'll hold to maturity.
Yeah, because in theory, the central bank does not have a constraint, not like a private sector. So that I think financial market stability is still the overarching mandate, regardless of whatever economic mandates they have. So I think they will be there, and they clearly are not comfortable with the way the 30 and 40-year yields are moving.
All right, so now we flip it back to the US. What's the chance of the US going back into QE mode?
Fairly likely at some point, right? Because if we are in bond vigilantes mode, we're just jumping, whether this is the UK or Japan or the US, debt levels are the focus and they are high. And if there's no serious solution to try and curtail the deficit at a time when investors are looking to rebalance their portfolio, then the Fed could be the buyer of last resort if there's too much disorder in the market.
The Japanese have also showed us, in terms of unconventional policy, yield curve targeting.
YCC, yes, it has been done before. In fact, I think the US did it during the war as well. So under extreme circumstances, I think extreme policies will be utilized. I mean, QE was considered novel back in 08, 09, but it's become very, very commonplace, and even EM Asia as well, we've been using it. Right? So as I think the management of the debt markets become more challenging, some of these will come into play.
It's like US is becoming more and more like EM as far as debt management is concerned. So these sort of things have started to make global investors unhappy and concerned, and therefore, as both of you have talked about, wanting to reach out to a broader set of assets. And sitting here in Singapore, we are beginning to see interest in bonds and JGBs and even CGBs as well, and Australian paper, Singapore paper rating differentiation is also beginning to sort of get some traction. So what is the data telling us? Are we seeing substantial increase in home buyers? Europeans bringing money back to Europe, the Japanese bringing money back to Japan and stuff like that?
Right, that's an interesting question. So looking at Japanese portfolio flows data, those come out on a weekly basis. Actually, it's not quite the case that domestic residents, which is the Japanese, they're taking advantage of the stronger yen to actually invest more in the US. But in terms of foreign investors investing in Japan, that has seen a very huge jump. So on a global scale, what we are seeing is perhaps some reallocation away from US dollar assets into alternatives, including Japanese JGBs, Japanese equities, so on and so forth. So there is not so much home bias, but I think a global bias towards looking to move out of.
Okay, let me ask the same question in the context of Taiwan, because there we saw the Taiwanese life insurance companies get very nervous about their massive dollar exposure, and then even slight bit of repatriation caused the Taiwan dollar to appreciate very sharply.
Right, I think it's interesting because they have such long dated liabilities, right, insurers. So as long as the policyholders, they don't choose to redeem the policies, they'll probably be okay. There could be some market losses, there could be some nervousness, but by and large, we don't see major risk of solvency risk coming to the table. But of course, Taiwanese insurers, if they think that the dollar downtrend is a more structural story, if they see US economic policy as not particularly confidence-inspiring, then yes, they'll start relooking at their portfolio exposure, which is actually quite huge. They are one of the biggest holders of US dollar assets. And if those guys start bringing money back to Taiwan or reallocating elsewhere, I think that's going to be a very consequential move.
And then there's the Chinese. What about the massive holdings of US treasuries by the Chinese?
They have fallen by quite a lot. And I think it's simply because of the size. I don't think they can find that many domestic investors.
Still close to $1 trillion, right?
700 plus official holdings, yes. Yeah, so they will have to diversify because I don't think they can find sufficient investments domestically. Yeah, so it will be a beneficiary for everyone else as well.
Or they go buy Apple and Google bonds instead of treasuries, All right, so a few questions on Pigeonhole. So let's put this on the screen. I think this was also on the
Yes.
WebEx window, so let's just pick it up here. With the selection process of the next Fed chair underway, an announcement expected soon, do you see policy shock coming soon, especially with hawk like Kevin Warsh? I don't know if Kevin Warsh is a hawk or a dove. During the days when he used to be a member of the FOMC, he seemed to speak in a very different tune than he does now. And I don't think Warsh is a done deal. Warsh has campaigned very heavily to be Fed chair. And I think if you were to ask me this question in December or January, before Trump took over, but after he got elected, I think Kevin was very much on the top of the list. But guess who is now throwing his hat in the ring? Mr. Bessent. So we saw a big article in Bloomberg overnight that, Bessent is now being considered also likely to be Fed chair. I think whoever goes, it is very clear in this administration you have to be fully aligned with Trump. There's no question of asserting independence of your views. And if indeed we see inflation not being a very big issue, despite the tariffs, because there'll be a lot of muddling of tariff and postponement and so on, then maybe whoever is the chairman after Powell will have a space to cut rates. Powell seems to be still guiding the market toward 50 basis points of rate cut in the second half of the year. By the way, I'm just so pleased that we were lazy with this forecast because the market has gone all over the place and they've basically come down to where we were at the very beginning of the year, 50 basis points in the second half. And beyond that, going into 2026, growth could slow furthermore. As we said, we're very sure about the investment downside, not too sure about the consumption one. And that would certainly, again, bring in a Fed chair, willing to cut rates. Probably will not get a lot of opposition from the FOMC members. It really depends on how far Trump wants to take this trade war. If he's hell-bent on creating a tariff mode and focus on only manufacturing in the US, we will definitely have inflation. And that will certainly complicate the Fed's job. But additionally, this issue related to what we just talked about, interest rate around massive issuance of US debt and the fiscal dominance that comes from that will also probably compel the Fed to be on a dovish plank. So this is, and by fiscal dominance, basically what economics literature says is when debt is so large and overwhelming, monetary policy becomes hostage to fiscal imperative. I can very easily see the US going in that direction. It won't be a shock. The market will expect it. So I wouldn't worry too much about the Fed governor. I think the stars are aligning for lower rates in the US, whoever becomes the governor. Next question. Ooh, a silver and gold question. I don't think anybody in this call is very comfortable answering this question. Where do you foresee the price and demand for silver and gold in the next 6 to 12 month time frame? We published a piece on gold about 3 weeks ago, and I tend to put our publications on LinkedIn. The biggest hit of 2025. I mean, no other article that we've written has that much interest. So clearly, the market zeitgeist in LinkedIn is very interested in gold. As I said earlier, when you have such high real interest rates, gold should be much, much lower priced. The fact that the gold is over $3,000 at a time when real interest rates are 2% and higher means that the traditional relationship is broken down. It's really all about the geoeconomic risks and uncertainty, which is compelling investors around the world, including American investors, become more and more interested in gold. So I would say that gold demand remains well supported going forward. Silver is a bit of a more complex story. It seems to me that it's like a second cousin of gold. That when we're talking about safe haven, it's gold that really takes off, and silver seems to be associated with a fundamental demand for silver in various industrial processes, and then some degree of speculation. I would remain more favorably predisposed toward gold. This is certainly for you, Eugene. In the next 10 years, do you see 10-year SOFR CMS breaking 6% mark?
Yeah, I think the issue here is that when you look at SOFR, right, it's trading at a large discount to treasury yields, and that's a reflection of fiscal worries. Right, so 10 years is a very long time. Right, so in order for 10-year CMS to go past the 6% mark, we probably require 10-year US yields to go past 6.5%. Right, so 10 years is a never say never question, but if you want to talk about market stresses, right, if 10-year US yields gets above 5%, I think the Fed would be worried, as will the Treasury. So I think that will be the first marker that we should be watching for. 6%, 10 years, would never say never, I think.
Right. So Eugene, I'm got a bunch of questions, but we don't have time to go over them, but just a couple of final words on this. Is the coming decade an inflationary decade or a disinflationary decade. You have opposing forces in place. On the inflationary side, you can say the U.S. has to inflate the U.S. economy to deal with debt. But then China with its excess capacity, and AI and automation of manufacturing, again driving down the cost curve. Those things could add to goods-related disinflation. And also on the services side, we might again see automation and AI sort of creating huge amount of value for companies, and therefore they don't have to give high wages to all the coders that they used to in the past, and that could drive service sector inflation come down because the value would be there. Or you could argue that innovation is very, very expensive, that to do the AI revolution and to underwrite that over the next 10 years, we would have to spend so much money on energy generation and so much money on data centers that we're going to drive up the cost of rare earth and a wide range of materials, and we'll actually have an inflation before the full gain of AI comes in. So I think there are opposing forces in place, but I think it is in the interest of the highly indebted economies in the world to have a bout of inflation. The Japanese, the Americans, perhaps even the Chinese. So I think from a policy motivation perspective, I can see desire for higher than targeted inflation. From a secular trend perspective, not so much so, but net, I think higher nominal rates might be the corollary associated with the higher policy imperative for higher inflation. All right, lots to chew on. These issues are not going to go away. We're going to come back month after month to go over them. We're all on our tenterhooks, and our life will remain very, very interesting going forward. Thanks, everybody, for dialing in. We will come back to you next month. I will be on vacation, but my colleagues will be around to take care of particularly Philip Wee. Until then, everybody, stay safe, stay healthy. Thank you, and bye-bye. Thanks, guys. Thank you.
Thank you.